Greetings everyone. In the last video, we looked at budget 2026 at a glance, the big picture. Now, let's slow down and ask a very basic but extremely important question. Where does the government actually get all this money from? Every road project, every welfare scheme, every defense purchase, all of it starts with government income. So in this video, we will break down government receipts using official budget data, explained in simple terms without jargon. Let's begin with the overall picture. For the financial year 2026-27, the central government expects non-debt receipt, meaning income earned without borrowing, of about 36.5 lakh crore. But the government total expenditure is much higher at 53.47 lakh crore. This immediately tells us something important. The government does not earn enough to meet all its expenses. The difference is covered through borrowing, which we will come to later. At the highest level, government income comes from three sources: tax revenue, non tax revenue, borrowings. Think of it as taxes, regular income, non tax revenue, additional support, borrowing, cap filler. Now, let's break these down one by one. Taxes form the largest and most reliable sources of government income. In budget 2026-27, gross tax revenue is estimated at 44.04 lakh crore. After sharing taxes with states, the center's net tax revenue comes to 28.7 lakh crore. This tax sharing is mandatory under India's federal structure. So, while the center collects taxes, a large portion flows to state governments. Taxes are broadly divided into direct and indirect taxes. Direct taxes are paid directly to the government and linked to income or profit. The two major direct taxes are income tax, corporate tax. Together, direct taxes form a significant share of total tax revenue. Let's start with income tax. For 2026-27, income tax collection are estimated at around 12 lakh crore. This includes tax paid by salaried individuals, professionals, small businesses. This number reflects growing formalization of the economy, better tax compliance, higher reported income. Yet it's worth noting that only a small fraction of India's population pays income tax. Next is corporate tax. Corporate tax collection for 2026-27 are estimated at around 9.9 lakh crore. This tax depends heavily on corporate profits, business cycles, investment climate. When companies do well, corporate tax rises. When the economy slows, it comes under pressure. Now, let's move to indirect taxes. Indirect taxes are included in the price of goods and services, so everyone pays them knowingly or unknowingly. The major indirect taxes are GST, custom duty, excise duty. Indirect taxes are consumption based, so they rise when spending rises. Among indirect taxes, GST is the most important. For 2026-27, the center's share of GST is estimated at about 11.8 lakh crore. GST is significant because it unifies the national market, reduces tax cascading, improves transparency. Every purchase you make contributes a small amount of government revenue through GST. Taxes are not the government's only income. The government also earns non-tax revenue estimated at around 3.8 to 4 lakh crore. This includes fees and fines, interest receipts, dividends from public sector companies, surplus transferred by RBI. Non-tax revenue is smaller, but it helps reduce borrowing needs. A major component of non-tax revenue is dividends and surplus transfers. Public sector enterprises pay dividends to the government. The Reserve Bank of India transfers surplus profit after meeting its requirement. In some years, RBI surplus plays a crucial role in boosting government income. Now we come to the borrowing, the most debated sources of government funds. For 2026-27, the government plan gross market borrowing about 17.2 lakh crore. Borrowing is used to bridge the gap between income and expenditure, fund infrastructure and long-term investment. Borrowing itself is not bad. The real question is how responsibly it is managed. Another income source is disinvestment and asset monetization. This means selling part of ownership in government companies, monetizing existing assets like roads or pipelines. For budget 2026, disinvestment targets are modest, reflecting cautious market condition. This rose help, but it cannot replace tax or borrowing. Let's step back and analyze. With borrowing at around 17.2 lakh crore, nearly one third of total government expenditure is supported by debt. At the same time, fiscal deficit target is 4.3% of GDP. Debt to GDP ratio is estimated at 55.6%. This shows a careful balancing act, supporting growth today while keeping long-term debt under control. So, Let's summarize. Taxes are the backbone of the government income. Non-tax revenue provides additional support. Borrowing fills the gap between income and spending. Understanding this helps us decode fiscal deficit, debate tax policy decision, government spending priorities. Now a question for you. Should government rely more on higher taxes or more on borrowing for development? Share your thoughts in the comments. In the next video, we will flip the story and explore why does the government spend this money. Thank you for watching and let's keep learning fact by fact.